Ever wondered how Reconstitution impacts an ETF's performance? Well, let's get into it. Reconstitution is, in essence, a kind of annual checkup for an exchange-traded fund, or ETF. It's a time when the ETF takes a good hard look at its portfolio and decides what's working and what's not. Think of it as a gardener pruning a tree. They'll cut away the branches that aren't bearing fruit, but they'll also look for ones that might, with a bit more care and attention. That's essentially what happens during an ETF's reconstitution. The fund trims away the stocks that no longer align with its objectives, and plants the seeds for new ones that do. In the case of the SCD Dividend Growth ETF, this reconstitution is a critical event. Remember, SCHD's primary focus is on dividend growth. It's not just about the stocks that are performing well now, but those that have the potential to deliver robust dividends in the future. This ETF, like a diligent gardener, is always on the lookout for these promising stocks, and once a year it takes decisive action, removing certain stocks from its portfolio and adding new ones. This isn't done on a whim, but after careful consideration of various financial factors. And why is this so important? Well, it's because this annual reconstitution helps to ensure that SCHD stays true to its mission. It's a way of making sure that the ETF continues to focus on dividend growth, that it remains a reliable investment option for those who value steady, long-term returns. And let's not forget, for anyone who has a significant portion of their investment portfolio in SCHD, like our presenter who has 49% of their investments in this fund, the reconstitution is a significant event. It can directly affect the performance of their portfolio and, by extension, their financial future. Now that we understand the importance of reconstitution, let's delve into the performance and dividend growth of SCHD. Historically, SCHD has shown impressive performance. That's not just a statement, it's a fact backed by numbers. Over the past decade, the price of SCHD has surged a whopping 116%. That's right. If you had invested in SCHD 10 years ago, you would have more than doubled your initial investment by now. But that's just the tip of the iceberg. When we factor in dividends, the picture becomes even more attractive. The total return of SCHD over the past decade, when including dividends, is an astounding 192%. That's nearly tripling your investment. Now, isn't that something? But let's not stop there. Let's delve a bit deeper into the dividends of SCHD. The fund has a robust dividend yield that starts at around 3.38%. This means that if you had invested in SCHD, you would have been earning a steady income from your investment in addition to the price appreciation. But what's even more impressive is the dividend growth rates of SCHD. Over the last 3 years, 5 years and 10 years, SCHD has consistently shown remarkable growth in its dividends. This is a testament to the fund's commitment to not just maintain but grow the dividends it pays to its investors. So what does this mean for you as an investor? Well, it means that with SCHD, you're not just banking on the price appreciation of the stocks in the fund, you're also earning a steady stream of income from the dividends. And what's more, these dividends are not just stable, but they're growing over time. So, you're essentially earning more and more income from your investment as time goes by. But remember, past performance is not indicative of future results. While SCHD has shown impressive performance in the past, that doesn't guarantee that it will continue to do so in the future. Investing always involves risks, and it's important to do your due diligence before making any investment decisions. But one thing's for sure. With its strong track record of performance and dividend growth, SCHD has proven itself to be a compelling option for investors looking for a combination of capital appreciation and income generation. Performance and dividend growth are key, but what about the objectives and strategy behind SCHD? Well, that's a great question, and it's one that we'll delve into in the next part of this video, so stay tuned. SCHD aims to track the Dow Jones U.S. Dividend 100 Index as closely as possible. This objective forms the bedrock of the fund's strategy. A strategy rooted in the pursuit of steady, reliable income through dividends. Now let's unpack that strategy, bit by bit. The first thing to note is the fund's emphasis on minimizing costs for investors. The SCHD Dividend Growth ETF sports an exceptionally low expense ratio of just 0.06%. To put that in perspective, imagine a $100 bill. The expense ratio is equivalent to a mere 6 cents of that 100. Minimal costs mean more of your investment stays invested, working for you. The fund's strategy is not just about minimizing costs, though, it's also about maximizing dividend reliability and financial strength. To achieve this, SCHD employs a meticulous stock selection process, It doesn't just pick any stock that pays a dividend, it carefully chooses stocks that have demonstrated financial strength and a consistent history of paying dividends. But how does the fund identify these stocks? The answer lies in an algorithm. This is not just any algorithm, but one designed to consider key financial metrics. These metrics include the ratio of free cash flow to total debt, return on equity, indicated dividend yield, and 5-year dividend growth. Each of these factors is a critical indicator of a company's financial health and its ability to sustain and hopefully increase its dividend payments over time. The free cash flow to total debt ratio, for instance, gives a snapshot of a company's debt management. A higher ratio indicates a company has more than enough cash flows to meet its debt obligations, a sign of financial strength. Return on equity, on the other hand, measures a company's profitability. A higher return on equity often points to a more profitable company, which in turn could mean more profits to distribute as dividends. Meanwhile, the indicated dividend yield provides insight into the income an investment in the stock could generate. And the 5-year dividend growth, that's a measure of the consistency and growth of a company's dividend payments over time. A strong track record in these areas can be a good sign of future dividend reliability. By considering these metrics, the fund's algorithm helps to identify stocks that not only pay dividends, but are likely to continue doing so. This methodical approach is designed to ensure that the fund's holdings represent strong and reliable dividend-paying stocks. So there you have it, the fund's objectives and strategy in a nutshell. SCHD aims to track the Dow Jones U.S. Dividend 100 Index as closely as possible, keeping costs low for investors, and selecting stocks based on financial strength and dividend reliability. And it does all this with the help of a carefully designed algorithm that takes into account key financial metrics. With the objectives and strategy clear, let's dive into the details of the recent reconstitution. The recent reconstitution witnessed 23 additions and 23 removals from the fund. Now let's dive into some specifics. Among the new additions to the SCHD Dividend Growth ETF are companies like Bristol-Myers Squibb, a global biopharmaceutical company, and Dick's Sporting Goods, a leading omni-channel sporting goods retailer. But why these companies? What makes them a good fit for the fund? Well, the selection process for SCHD is driven by an algorithm that focuses on a few key financial metrics. It's not just about a company's current dividend yield, but also its historical dividend payments, financial strength, and dividend reliability. This methodical approach aims to ensure that the fund's holdings represent strong and reliable dividend-paying stocks. Take Bristol-Myers Squibb, for instance. It's a company that has consistently shown robust dividend growth and financial performance. With a history of stable and growing dividend payments, it aligns perfectly with SCHD's commitment to dividend growth. The same goes for Dick's Sporting Goods. Despite the challenging retail environment, it's a company that has not only managed to stay afloat, but has also thrived, demonstrating impressive financial performance and consistent dividend growth. But it's not just about the additions. The reconstitution also involved removing 23 stocks from the fund. While the reasons for removal can vary, they generally revolve around the same key metrics used for selection. Perhaps the yield isn't quite up to par, or maybe the company's financial strength has dipped. It's a continuous process of fine-tuning, ensuring the fund stays true to its objectives. And it's not just about individual companies. The reconstitution has a broader impact on the fund's sector distribution. For instance, this year's reconstitution has seen an increase in the representation of financial services stocks. This isn't a haphazard decision, but a result of the fund's algorithm picking up on the sector's strong dividend growth and financial performance. This process of reconstitution of adding and removing stocks is a crucial part of ensuring the SCHD Dividend Growth ETF stays on track. It's about ensuring the fund continues to align with its mission of focusing on dividend growth, of offering a portfolio of strong, reliable, dividend-paying stocks. It's a testament to the fund's commitment to its investors and its objectives. But remember, while we've highlighted a few additions and removals, there were a total of 46 changes made during this reconstitution. Each of these changes, each addition or removal, was made with careful consideration and a focus on the fund's long-term strategy. It's a complex process, one that requires a deep understanding of the market and a clear vision for the future. These changes reflect the fund's commitment to dividend growth. But what does this mean for the sector distribution within the fund? We'll delve into that next, looking at how the reconstitution impacts the fund's sector distribution and what that means for the future of the SCHD Dividend Growth ETF. The reconstitution has brought some changes in the sector distribution within the fund. Indeed, it's not just about replacing stocks, it's also about adjusting the balance of the sectors within the fund. This time around, we've seen a noteworthy increase in financial services stocks. Now, why is that significant? Financial services companies such as banks and insurance firms have a long history of paying consistent dividends. They're like the reliable workhorses of any dividend-focused portfolio. But there's more to it than just history. The current economic environment is also a factor. With interest rates on the rise, financial institutions tend to benefit. They can charge more for loans, boosting their profits and consequently their potential to pay out dividends. So, this increase in financial services stocks could be seen as a strategic move by the fund, aligning itself with the broader economic trends. Now let's talk impact. What does this mean for the fund's performance? Well, generally speaking, a higher concentration of financial services stocks could enhance the fund's dividend yield. It could also add a degree of stability. Financial services companies are typically less volatile than, say, tech stocks, so they can provide a buffer against market swings, enhancing the fund's overall stability. However, it's important to remember that every investment has risks. While financial services companies are typically stable, they are not immune to economic downturns. And as with all sectors, the performance of financial services stocks can be influenced by a range of factors, from regulatory changes to global economic conditions. But that's where the beauty of an ETF like SCHD comes in. Its diversified portfolio, spread across various sectors, helps to mitigate these risks. Each reconstitution is a step towards fine-tuning this balance, with the ultimate goal of providing a steady stream of dividends for investors. For those who want to delve deeper, we have a detailed spreadsheet of the reconstitution. This document will give you a clear view of the changes made and the rationale behind them. It's a valuable resource for anyone keen on understanding the finer details of this dividend growth ETF. This resource provides a comprehensive and in-depth look at every aspect of the reconstitution. It meticulously lists all the additions and removals from the fund, giving you a clear understanding of the rationale behind each decision. This isn't just a list of company names, but a detailed analysis of each stock's performance, dividend reliability, and growth potential. The spreadsheet also provides a closer look at the overall strategy adjustments made during the reconstitution. It sheds light on how the fund continues to align with its core objective, focusing on strong, reliable dividend-paying stocks. This resource is an invaluable tool for those who wish to gain a deeper understanding of the fund's dynamics, strategy, and commitment to dividend growth. In conclusion, the annual reconstitution plays a vital role in maintaining SCHD's focus on dividend growth. To wrap up, reconstitution is a key event in the life of an ETF like SCHD. It's through this annual recalibration that the fund sustains its commitment to dividend growth. The process involves thoughtful additions and removals, based on a meticulous algorithm that values financial strength, dividend reliability, and other crucial metrics. This year, for instance, we saw 23 new entries and equal exits, fine-tuning the fund's portfolio to better align with its core objectives. The performance of SCHD has been impressive, boasting a strong dividend yield and significant growth rates over the past decade. This, coupled with its low expense ratio, makes the fund an attractive choice for many investors. For a more detailed look at the reconstitution, the fund's prospectus is your best resource. Remember, understanding how your investments work is a crucial step towards achieving your financial goals. If you found this video insightful and want to stay updated with the latest ETF insights, don't hesitate to hit the subscribe button. We regularly post content that helps you understand your investments better, thereby empowering you to make more informed financial decisions. Got any thoughts or questions about SCHD or any other investment topics? Feel free to drop a comment below. We appreciate your engagement, as it helps us create more valuable and relevant content for you, so don't forget to like, share, and subscribe. Thank you for watching, and remember, your financial journey is important to us.